Good day, students. This is CMA Mrudula. Today, I am here to continue the marathon revision series. So, we had started the revision series with the subject financial accounting. So, let's get on with the second part of the revision series for the subject financial accounting. I hope the videos are useful for CA Inter and CMA Inter students. I'm looking forward for some genuine feedback from the students so that I can create appropriate content. So please let me know if you like the videos and find them useful. So let's begin part 2. Let's begin revision 2. So in the second part of the marathon revision series for financial accounting, we're going to cover these chapters: preparation of financial statements for profit oriented, not for profit oriented, and incomplete records, and self balancing ledger chapter. Let us first understand some basics with regard to preparation of financial statements. Financial statements includes trading and profit and loss account, balance sheet, cash flow statement, explanatory notes to accounts, and statement of changes in equity. So which means each time you prepare financial statements, you have to prepare all these above list of statements. Let us understand the basic purposes of the statements that is mentioned. So trading account is prepared to identify the profits or losses made by the business due to the business operations during the period. That is only the sales, purchases, and those related to the major objective of the business. That is called gross profit or gross loss. Profit and loss account is prepared to arrive at the total or the net profit or loss made by the business during the period. Balance sheet denotes the statement of affairs of the business at the end of the period, which means how much assets are owned by the business against the liabilities that is present for the business. Cash flow statement is a statement which denotes the movement of cash during the period. It is applicable only to certain companies. The applicability and the preparation of cash flow statements is covered in Accounting Standard 3. Explanatory notes to accounts are notes which denotes the basis on which the items that have gone into the trading profit and loss account and balance sheet are arrived at, which means the calculations for the items which have gone into the statements mentioned above. Statement of changes to equity denotes the changes in the equity share capital during the period for which the financial statements are prepared. So now I'll be going slightly in detail with regard to preparation of financial statements. Let us understand the basics behind preparation of financial statement and the steps that is to be followed while preparation of financial statement at every period end. So throughout the year, journal entries would have been passed using a double entry system of accounting for all the transactions. Double entry system of accounting simply means every entry will affect two ledger accounts simultaneously. For example, while purchasing an asset account will be debited and cash or bank account will be credited. So when we have to prepare financial statement at a period end, first of all the ledger accounts are totaled up. Totaling up means arriving at a closing balance figure for all the ledger accounts. So generally, in a ledger account, one side, that is either debit or credit, one side will have more number of entries, which means a higher amount. Say for example, in an asset account, debit side will have more number of entries, and which means the debit side amount will be higher than the credit side amount when totaled up. Okay, so the debit side amount is reduced by the total amount of the credit side, and this way a closing balance figure is arrived at. So for asset accounts will always have a debit balance. Liability accounts will always have a credit balance because the credit side will have more number of entries and will have a higher amount. Expense accounts will always have a debit balance, and income accounts will always have a credit balance. Now, these balances will appear on the opposite side of their nature. That means if asset account will have a debit balance, which means the debit side will have a higher amount, it will appear on the credit side, called balance carried forward. Now, how did we determine that asset account have a debit balance, liability will have a credit balance, and so on and so forth? It is determined due to the golden rules of accounting. So, assets and liabilities are generally either real account or personal account. What is the golden rule for real accounts? Debit what comes in and credit what goes out. What is the golden rule for personal accounts? Debit the giver, credit the receiver. Expense and income accounts are nominal accounts. What is the golden rule for nominal accounts? Debit all the expenses and credit all the incomes and gains. In asset and liability accounts, this closing balance figure will appear as balance carried forward. Whereas in nominal accounts, that is expense accounts and income accounts, the closing balance will be reflected as to profit and loss account or by profit and loss account. Because while preparation of financial statements, the nominal accounts are closed and there is no carry forward of this account. The next period, a new nominal account is opened. This is done so that the transactions of expenses and incomes of one period does not affect the transactions of the other period and hence does not affect the profit or loss of the next period. Now, after obtaining the closing balances of the ledgers, these are posted in a statement called trial balance. In the trial balance, the debit side and the credit side is required to be tallied. Tallied means matched. A trial balance format looks something like this. Since we are following the double entry system of accounting, the debit side and the credit side should and will automatically match. So at these points of time, that is while totaling the ledger accounts and while posting to the trial balance and while totaling up the trial balance, errors, if any, in the books of accounts can be identified. Then the items that is listed in the trial balance are segregated based on which statement it should go to: trading account, profit and loss account, or balance sheet. So as discussed, the trading account will denote the gross profit or gross loss made by the business during the period. The profit and loss account will contain the other income and expenses, which will be adjusted to the gross profit or gross loss to arrive at the net profit or net loss. Now, other income and expenses, for example, includes rent expenses, electricity expenses, salary paid, discount received, taxes paid, etc. Now, this net profit or net loss amount is taken to the balance sheet and added to the heading share capital. Now, the balance sheet items from the trial balance are taken and grouped under specific headings. Say, for example, the machinery, furniture and fixtures, vehicles are taken under the heading fixed assets. Debtors, stock, cash in hand, cash at bank are taken under the heading current assets. Similarly, sundry creditors, bills payable, bank overdraft are taken under the heading current liabilities. Loans from banks, debentures are taken under the heading long-term liabilities. And share capital is shown under the heading share capital along with the net profit and net loss are shown under the heading capital. Again, the asset side and the liability side of the balance sheet has to match and get tallied. If it does not match, there is possibly some error in the preparation of the financial statements starting from the trading and profit and loss account, which has to be re-verified. So in exams, this is a double check for students. If your balance sheet does not tally, possibly you have to recheck your other steps. Now that we have segregated the items present in the trial balance, we also have to understand that there are certain items below the trial balance which also would require adjustments in the statements because they do not appear in the trial balance. Now, items mentioned here, say closing stock, depreciation, outstanding expenses, outstanding income, expenses paid in advance, and income received in advance, do not exactly appear in the trial balance, but they appear below the trial balance. So, these are adjustment items. Okay, so closing stock should be presented in the trading account on the income side and also on the balance sheet on the asset side. Depreciation must be shown in the profit and loss account as an expense and in the balance sheet by reducing the asset amount. Outstanding expenses must be adjusted in the profit and loss account, the respective expense, and must be shown in the balance sheet as a liability. Outstanding income must be adjusted to the respective income in the profit and loss account and must be shown in the balance sheet as an asset. Expenses paid in advance must be adjusted to the respective expense by subtracting in the profit and loss account and must be shown in the balance sheet as an asset. Income received in advance must be reduced from the respective income in the profit and loss account and must be shown on the balance sheet as a liability item. Now, these items, as you can notice, are shown in two statements simultaneously and not just one, unlike the other items that are present in the trial balance. So, items below the trial balance are adjustment which must be shown in two statements, that is balance sheet plus either of trading account and profit and loss account. Let us now understand certain specific items that are unique to profit-oriented companies in preparation of financial statements. Provision for bad debts and bad debts. So, when there is a doubt cast on the collectability of debtors, a provision is created for bad and doubtful debts. Okay, but when the business is sure that the amount cannot be collected from the debtors, then the debtors amount is transferred to bad debts account and the bad debts is eventually written off by transferring the bad debts account closing balance to the profit and loss account. Now, what is a provision? Provision is an accounting estimate. Okay, it is created when an expense exists but the amount cannot be precisely estimated. Say, for example, provision for taxation, provision for bad and doubtful debts, provision for the March month electricity charges, which are for which the bill is received only in the month of April and even the payment is made only in the month of April. But we have to create a provision in the month of March because the year ends in the month of March. In the exams, question will generally provide the students with the trial balance from which you'll have to prepare the other statement, that is trading profit and loss account and balance sheet. So which means we can follow the steps above only if the books of accounts are prepared completely and properly. What if there are no proper records and no complete information of the transactions that were created by the business for the period? We still have to know the net profit and net loss made by the business during the period, and we also should know the status of the assets and liabilities of the business at the end of the period. So, for such businesses having incomplete records, we follow different steps. So, this is the case generally with small businesses and sole proprietorships. So, let us discuss the preparation of financial statements for companies or businesses having incomplete records. Step 1. Prepare opening statement of affairs to know the opening share capital, also known as the opening capital fund. Then another closing statement of affairs is prepared to know the closing capital fund for the period. But in this statement, no profit and loss items are taken and adjusted. This is just to identify the closing capital fund. Put yourself in the shoes of small businesses. See, in small businesses, whatever amount is made from the business activities is generally put back into the capital fund of the proprietor or the owner, okay, after he takes a small share for himself. So, which means to say, any profits made by the business during the period is also put back into the capital fund. So, which means any changes in the opening and the closing capital funds could be due to the following reasons. One, the net profit made by the business during the period, or additional capital introduced by the proprietor, or withdrawals by the proprietor, or net loss that is withdrawn to make up the cash flow. So, which means we have a different method to identify the net profit or net loss made by the business during the period. That is the difference between the closing capital fund and the opening capital fund. The two tables mentioned here represent the same idea and the logic. The format slightly differs. So like we discussed a few minutes back, Net profit and net loss made by the businesses having incomplete records can be identified by subtracting the closing capital fund and the opening capital fund, because the difference could be the net profit. But the difference could also be due to other factors like withdrawals and capital introduced. So those must also be adjusted with this total difference. So we add back the drawings which was made by the proprietor during the period to nullify the effect of such drawings. We subtract any further capital introduction by the proprietor to again nullify the effect of such capital additions. Then we arrive at the difference which is only due to business transactions. Then we have to subtract the indirect expenses to arrive at net profit or net loss. So reduce the depreciation, bad debts, and any other indirect expenses that would have been incurred by the business. Indirect expenses are items which would ideally have gone to the profit and loss account. So after arriving at the net profit or loss, appropriations of profit is made, and then a divisible profit is arrived at. So appropriations of profits means distribution of profits towards the proprietor's salary or interest on the capital that the proprietor is supposed to receive. And then this is the divisible profit that goes back into the business funds. This table also denotes the same logic, just that it is denoted in a ledger account format where we have closing capital brought down on the credit side, subtract the opening capital from that, adds the drawing, subtract the further capital introduced, arrive at the difference due to the business activities, bring that down, subtract the depreciation and bad debts, arrive at the net profit. Appropriations, if there are any, can be done by further extending this table, bringing down the net profit, subtracting the appropriation, and arriving at the divisible profit. The final step is to prepare a closing statement of affairs with all the profit and loss adjustments and the net profit and net loss added to the capital fund. The above two different steps that were discussed was for businesses having one of their objectives of making profits, which is why we had trading and profit and loss account to show the net profit or loss made by the business during the period, or different statements for the same purpose. There are many institutions or organizations which also have to maintain accounts just to keep track, but do not run for profit motive, but for other specific objectives like healthcare, education, ashrams, etc. So for such organizations, the steps will slightly differ and the statements also will slightly differ. So preparation of financial statements for not-for-profit organizations. First, we prepare something called a receipts and payment account. This is prepared to denote the cash flow during the year. It is a real account because it has to denote the cash flow. It has to be prepared on cash basis of accounting and not the usual accrual basis of accounting. And this cash basis of accounting is only for this account, receipts and payments account. So under cash basis of accounting, we account for all the cash movements, okay, irrespective of the amount falling due in that period. We will discuss about the different bases of accounting in detail in the accounting standards chapter. Then an income and expenditure account is prepared. Income and expenditure account is similar to profit and loss account. Okay. A separate trading account as such is prepared only for restaurants, and that will be mentioned in the question. Okay. Otherwise, you just have to prepare one single account called income and expenditure account, which will contain all the incomes and expenditure, and no bifurcations are required to be made. Then an opening balance sheet is prepared to identify the capital fund. Using this capital fund and all other assets and liability items and the net profit and net loss determined from the income and expenditure account, including the cash closing balance determined in the receipts and payments account, a closing balance sheet for that period is prepared. So question may provide either the receipts and payments account or the income and expenditure account, and students will be asked to prepare the other statements. Let us now discuss some specific items which are unique to not-for-profit organizations. Subscriptions, membership fees, entrance fees, donations, honorarium and prize funds are unique items to any NPO. Okay. Subscriptions are fees paid at regular intervals by the members for usage of specific services provided by the NPO. Prize fund is a specific fund created by the NPO by keeping aside some cash just for distribution of prizes during events conducted. Prize fund is a liability item and subscriptions is an income item. Honorarium means honorary charges paid for obtaining professional services for a nominal charge. So honorarium is an expense item. Now subscriptions generally would require some adjustments and calculations that are to be done. Okay. Subscriptions is generally the area where students have a lot of doubts. So this is the format that is followed for the specific adjustments required to be done for subscriptions. The calculation for subscription can either be done in an account format or a statement format. Let us first look into the account format. So in an account format, the debit side will have the previous year outstanding amount that is not yet received, the current year income due, and the next year's advance amount that is already received. The credit side would have the current year advance amount received in the previous year, current year amount received in cash, and the current year outstanding amount not yet received. Let us understand the logic behind the calculation, whether you do it or present it in an account format or a statement format. Let us understand the logic behind the calculation. So if we are provided with the information of the cash amount of subscriptions received during the current year, and we are to arrive at the amount of the actual subscription income due for the current year, then this is the flow to be followed. So the cash received in the current year, the cash could also be the previous year's amount outstanding or an amount received in advance for the next year. So such amounts are to be reduced. Reduce the previous year outstanding amount that is received in the current year and the next year advance amount received in the current year. Now, there could be some amounts that is due in the current year but not yet received or received earlier. Such amounts are to be added. That is current year advance received in the previous year and current year outstanding not yet received. So when we add these amounts, we will arrive at the actual subscription income due in the current year. That is to be accounted in the income and expenditure account. And why are we arriving at this figure? It is because the income and expenditure account is prepared on accrual basis. That is, accrual basis means account for income and expenditure as and when they fall due and not when they're actually paid or received. Another scenario where the actual subscription income for the year is mentioned in the question, but you're supposed to arrive at the cash received in the current year. So what do? First of all, reduce the current year subscription income already received in the previous year, and also reduce the current year outstanding amount, that is current year's income not yet received. Add to it the previous year outstanding amount received in cash in the current year and the next year advance received in the current year. So basically these 2 points are the cash flow which we are adding, and these 2 points are with regard to the current year's income which are not yet being received. So after these adjustments we will arrive at the actual cash received in the current year. So this logic can be followed for other income and expenditures such adjustments are necessary to be done. Okay, all the other information will be provided in the question. The final step is to prepare a closing statement of affairs, okay, which is similar to a balance sheet. This closing statement of affairs would contain all the assets and liabilities and the income and expenditure items to be adjusted to the assets and liabilities, including the surplus or deficit. So, the profit or loss determined in the income and expenditure account is called surplus or deficit in case of NPOs, because as we have already discussed, NPOs are not for profit organizations. So we do not use the term profit or loss, we use the term surplus or deficit instead. So now we come to an end of financial statement preparations. We've covered financial statement preparations for profit oriented businesses, for NPOs, and for businesses having incomplete records. Let's move on to the next chapter of this revision part 2. So let's begin the next chapter, self-balancing ledgers. Let us first understand the logic behind this chapter. So huge companies would have many transactions during a year. Okay, they'd have many sales, many purchases. Okay, voluminous transactions. So which means to say they would have many debtors party ledger account and creditors party ledger account, because they would be dealing with many different parties for sales and purchases. Now we understand that every party of debtor would have a separate ledger account, isn't it? So which is why in huge companies there'd be several debtors party ledger account and creditors party ledger account. Now, what would happen is at the period end, when the company has to prepare financial statements, it would get difficult to keep track of so many accounts, close so many ledgers, and tally in the trial balance. It would also become difficult to locate errors. Hence, the system of self-balancing ledger was introduced. What does this system do? On one side, which hits the debtors party ledger account or the creditors party ledger account, all those party ledger accounts, take one, say debtors party ledger accounts, are grouped into one single account called the debtors ledger adjustment account, DLA. Similarly, even the creditors party ledger accounts are all grouped. All the parties are grouped into one ledger account called creditors ledger adjustment account, CLA. So we have DLA and CLA, two accounts instead of many different accounts. Now we are all following the double entry system of accounting. Okay, so there would be another side of the transaction apart from the creditor or the debtor, right? That would be a real or a nominal account. Let us take an example. An example of a sale transaction, it would the sale entry would be debtors party ledger account to sale account, right? So that is a nominal account, okay? Or for example, when we are receiving cash from one of the parties, it would be cash account to debtors party ledger account. So what about that real or nominal account? Okay, which ledger would that get affected in? That also, all those real and nominal accounts are also grouped into one single account called the General Ledger Adjustment Account, GLA. So which means cash account, sale account, purchase account, discount received account, discount allowed account, bills receivable account, bills payable account, all of that is grouped into one account called the general ledger adjustment account. So which means there are only three accounts, the DLA, CLA and the GLA. So this would make the process at the year end or the period end for preparation of financial statement easier, and also location of errors easier. Let us look into the comparison between normal circumstances and SBL accounting to understand SBL better. So normal circumstances, a sale entry would be debtors account to sales account, whereas in SBL it would be DLA to GLA, right? When we receive cash from debtors, it would be cash account to debtors account. In SBL system, we would account it as GLA to DLA. So now, as you can see, the nominal account of sales and the real account of cash are grouped into one account called the GLA, right? Now, in case a check that was received from the debtor was dishonored, right? Check that was received here was dishonored, I would reverse it. So that would be debtor's account to bank account. That would be DLA to GLA. If a bill receivable that was drawn was dishonored, also I would reverse it. That debtors to BR account, that would be DLA to GLA. There was a return inward, that is a sale being made returned. That would be sale returned to debtors because debtors is reducing. In case of SBL, it would be GLA to DLA. In case of BR is drawn, it would be again debtors is reducing and BR account is being created, as we've already seen in the BOE chapter. So the entry would be BR account, that is billed receivable account to debtors account, and in SBL system it would be GLA to DLA. Uh, if there's a discount allowed to debtors, it would be discount account to debtors account. Again, debtors is reducing. SBL system, it would be GLA to DLA. Bad debts, that is written off. So debtors account reduces. Bad debts to debtors account. In SBL system, it would be GLA to DLA. The similar logic would follow in case of creditors. Okay, examples that is mentioned here is only with regard to debtors, but the similar flow would follow in case of creditors. So which means accounting is a lot more simplified than the SBL system. Okay. Students just have to pay attention whether the DLA or the CLA have to be debited or credited. So when debtors is increasing, DLA has to be debited. When the debtors is reducing, DLA has to be credited. What is it in case of creditors? If creditors is increasing, CLA has to be credited. If creditors is decreasing, CLA has to be debited. Okay. So once this is clearly understood by the students, passing entries under SPL is very easy, because if you know one side of the entry, the other side simply goes to GLA account. So in the examinations, question would provide information with regard to these transactions, say cash received, BR created, BR dishonored, okay, and accordingly the students have to pass entries in ledger account. Okay, so generally the question would ask the student to prepare either one of the accounts or all of the accounts, that is all three, DLA, CLA and GLA. So we come to an end of revision part 2 for financial accounting. Two more revision videos for financial accounting coming up the next couple of days. Let me know if you like the videos, if you find them useful and have some genuine feedback. Also, let me know if you want a detailed discussion of any specific topic under this subject to be covered. Thank you. All the best.